Welcome to Cheques and Balances. I'm Michael Vincent. This is James Blair. And this week we're joined by David Boyle, and we're going to be discussing DIY investor versus advisor-based investing.
Okay, I'm very excited for two reasons. The first reason is we're joined by David Boyle today. David, how are you?
I'm very good, James. How are you?
That's good. Yeah, no, I'm great. The other reason, which is obviously a very far second, David, but we're in a studio, which, Mikey, we've made it.
We have. We're selling out Wembley.
Yeah.
It's very exciting.
We've got our mums to get multiple VPNs so we can justify being here. But it is quite exciting to be in a space like this. So, David, I've known you for a little while. Actually, I used to see you join our Westpac conferences back in the day, where you would come in your old role as GM of Investor Education at the Commission of Financial Capability. But most recently, you hosted or chaired the FMA debate, which is where this topic comes from today. So for those that aren't aware, the FMA is the regulator of financial advisors, really the financial sector. And there was a topic of DIY investing versus advisor investing, which was quite a lot of fun, wasn't it, David?
It was a great topic. And there was some really good points made, but also a bit of laughter, which helps in our industry.
Yeah, so we're very lucky to have David with us today. He's out in the market a lot, sharing the word around improving financial literacy. I think you write a few articles. You're out doing lots of different things. Your role at the moment, head of sales and marketing at Mint, how's that going?
It's going really well. I mean, Mint has grown substantially over the last 5 years. We're an investment house, essentially. And we just have created a new holding company called Amplify. So some exciting times, hopefully. Yeah.
Nice. It's actually funny when we think about it, Mike, that we originally, so the FMA debate was in July, August?
Yeah, it was. I think, late July, early August.
Yep. And then we said the next week, hey, David, how about you come in and we'll do a podcast? And, of course, that got cancelled because we went into lockdown. Then we naively said, hey, let's do this a few weeks later. Yeah. And here we are nearly at the end of the year.
It is scary. I mean, I think for everyone, and particularly in Auckland, I'll be pleased to get to that next traffic light system and get out a wee bit from the zone.
Yeah. And I think that's not only good for everyone in Auckland, but good for the rest of the country as well, to give the economy a bit of a kick over summer.
Oh, I'm so excited.
Yeah.
Doesn't sound it.
Yeah.
I've cheekily booked my tickets to the cricket test match in Sydney for early January.
Brilliant.
Some would say very hopeful of me, optimistic, but hey, I am who I am.
Good stuff.
Okay, cool.
So, Mike, the structure of today's podcast is, and what do we call it? The session we had that you hosted a while ago.
Yep.
DIY investing, the rise of the Sharesies, the InvestNows, Hatch.
Yep.
Talking about those versus the traditional advisor like myself. So, Mike, you got the hard-hitting questions. David, hopefully you've got some answers.
We'll give it a crack.
And I might jump in a little bit as well.
Yeah. So I guess with this topic, it's important to give sort of a background on, I guess, the platforms that we're discussing and what they sort of bring to the market. So let's start on the platform side of things. Can you guys run me through the benefits of these platforms?
Yeah, I'll kick off, and James, you think about what might work from your perspective. But the introduction of platforms, the way I look at it is really giving New Zealanders greater access to investments or direct investments like shares, bonds, and a very simple, easy way and an affordable way.
Yep.
So in the old days. I say old because I'm pretty old, but back in those days, you had to have quite a large amount of money to invest and go through a broker traditionally. So this way, it's quite efficient. You can start off even with a very small amount of money, or you can drip feed and regularly invest. So accessibility is probably the key thing that's really driving that. And think of them as a supermarket. They essentially just have shelves of investment options, and you can pick and mix as you like.
Yeah, I agree with that. And I think what happens off the back of accessibility to the market is education. So there's, for the right types of people, which we'll kind of get into a little bit later, those who really want to be involved in their investing strategy and DIY it for themselves, they've got the ability to learn as they go, educate themselves, build their own portfolio. And I think I've told this story to you, Mike, before. My partner or fiance, Hannah, she has never been into money, never been interested. She opened a Sharesies account when it kind of opened up, a few years ago. And she's gone from just picking a couple funds to looking up funds at companies at night and pitching to them to me as I try and fall asleep. And I'm like, and
they say romance is dead.
Yeah.
and to me, that's one of the big benefits of what's happened with a company like Sharesies, is Hannah would have never been interested. Her situation, our situation, the old, you have to have $1 million to talk to an advisor or paying outrageous brokerage fees. It's just completely changed the market.
Yeah, it has. And I guess social media has really opened up those opportunities. And it's a double-edged sword, really, because there's this fear of missing out, FOMO. It's not bad for an old fella coming up with that. But
Hashtag.
hashtag really. But the problem is that many of those investors were probably chasing other people's thoughts. They weren't necessarily probably that au fait with it or understood kind of the risks. And that's some of the things that we need to probably dissect a little bit during this conversation, because it's great to have accessibility. It's all fun and laughter when the markets are going up, but what happens when they go down? And what's your diversification like in respect to those investments? So COVID has really, in my view, under lockdown scenarios, really opened that direct market, because actually people were looking, just had time on their hands. So that kind of got people signed up, and that's where a lot of those direct online platforms have grown from.
Yeah, and I think that the diversification point is quite key there, because, I'm not sure if you're aware of this, David, but Kiwis have sort of an obsession with property.
Says the mortgage broker.
Yeah. And this is another avenue for at least introducing people to, like you said, traditionally what was a bit more of a closed-off market, by way of sort of a barrier to entry being how much capital you had to invest, and the knowledge piece as well. But, just because you're diversifying away from property, are you diversifying correctly? Is what you're investing in right? Are you investing for the right reasons? I think is probably the question there.
Yeah, it is. And look, the beautiful thing is that the majority of those that are on those types of platforms that have just started have got small amounts of money on average going in. So with a correction, or with perhaps companies losing those equities, or the power of the value of those equities, it won't necessarily hurt them too much, but a good correction, and I hate saying that, will probably give a little bit more balance to the benefits and reasons why you need to think about what are your real goals with this money. Is it just to make money like betting? And I know that some investors are doing that, where they weren't able to bet outside the market because of COVID. And then there are those that are just experimenting, and hopefully they'll get a little bit of education through their own kind of actions, and then seek some advice as they go. Because you've got to have a plan. You can't just put money in the market and expect it to grow. Yeah. So there's there's a balancing act, and I think there's more work to be done in that area. And I would say the regulator would be thinking about this very much as well, around what other tools will they have to help assist with those investors.
The point around a long bull market, I think, is very relevant. If you think about how high all asset prices are at the moment, the fact Sharesies invest now since their inception have had a bit of volatility. But some people mistake the COVID drop in March last year as a correction, and that was a little blip, right? The corrections don't last 4 weeks.
No, I mean, we're almost getting a generation that have not experienced a bear market, and if I hear anyone say that, the environment's changed, or that, we're in a new normal, well, we're probably not. I mean, there's always a cyclical outcome, and valuation is all relative to the buyer and seller at the end of the day. But for those who've got kind of larger amounts of money that haven't really thought about what they want to do with that, I think this is a time for them to reflect and maybe look to get some more professional support to help them reach their goals.
Yeah. Okay, then. So let's flip it around to the other side. So obviously accessibility is massive. The education piece, the affordability as well, and obviously a little bit of diversification there, and the ability to diversify quite easily. out of property. What's the downside?
Well, the downside is they're going to lose money, a lot of it. Genuinely.
That's the short of the long.
Look, it really is. And, there's the experience will show, I suspect, and you don't want this, and you kind of hope that investors using platforms have also got money elsewhere, probably KiwiSaver, hopefully, and other investments. But if they're relying on this money to continue what it's been doing over the last few years, they're going to be in for a bit of a shock, to be honest.
Yeah, and David, I'll give you a little bit of an insight since this is your first time on the podcast. I'm dubbed as Statman around here.
Oh, good.
Mike tried to come in and he came in with some hot stats
That's
about a month
wild
ago.
stats, yeah.
He was just throwing them out left, right. So he was quoting I think, what was it?
Was it
Ecuadorian inflation rates, and it was getting a bit crazy. But in March last year, and I think you might have written something around this as well, around the dollar figure of KiwiSavers that went from growth KiwiSavers to conservative KiwiSavers. There's about $1.2 billion that went from high risk to low risk, and then only about 120 odd million that went back to high risk. So once again, when we think about that sharesies market and people are going to lose money at some point when there is that correction, that they haven't experienced that yet. And you can see what people have done historically over a very short period of time.
Yeah, the experience of seeing your capital value go down, it doesn't mean that you've lost that money, but the value of what you've invested in has gone down. That's going to be a real education, and particularly for those that are buying direct shares or single shares in one or two different companies, that's not diversification. And they could be materially impacted, hopefully with smaller amounts of money so they can learn from that and stay in it if they're good quality companies. But how do they know that? Have they done the research? Have they sought third-party confirmation around that? And I'm hoping that they have, but I suspect many have just talked to their buddies and their mates and followed kind of what's on Reddit, because I've seen some appalling.
And of course, it
really it shocks me a little bit. So there will be a time where there will be a bit of reckoning around this. So let's hope that people do actually seek a little bit more support or work out really what they need to be doing with that money.
And that FOMO piece is a really big driver for a lot of people's the whys behind why they're investing, right? And James and I do webinars with a few different companies, just financial literacy, and we do one on investing. And undoubtedly, we always get a similarly worded same question, which is, tell me what the next Apple stock is going to be, or tell me the next absolute long shot Hail Mary that I can throw half my money into and I'll be a billionaire. And it just gives an insight into the psyche of this, why are you investing? What is your long-term goal? What is your plan? And a lot of the time it's just, I want to get rich quick.
Yeah, it is that. And I think, GameStop was an article I wrote about a particular stock that was just driven predominantly by, I can't even call him an individual. I mean, it was pretty bad. And, upon reflection, I mean, that was an example of where social media has a lot to really answer for. And I do worry how that will influence investors going forward. And so we need to get that balance, because as we know, when you're following something, you will continue to be fed that information that you're looking for, rather than giving you a balance of perspective. And you've got to step out of that and actually go back to the basics and say, well, what do I really want to do from an investment perspective, and what are those goals? So, I really hope that there'll be some balance out there. But anyone that's following Reddit probably won't be seeing this video because it won't come up in their feed.
Hey, maybe if
it will.
The Reddit advertising works, it might pop up. But I think that's a really valid point around essentially some people are trying to do Hail Mary type plays. And with social media, out of 7 billion people, some people are going to win the lottery. It's just how it works. And then you apply that and go, that can be me. I think the other problem, Mike, around to the point around there will be a correction at some point, people lose money, is not having that conversation linking your goals to your investment decisions. So if you are, and we see this all the time, right? hey, Mike, I want to buy my first house. I've got all of my money sitting in crypto. I've got all my money sitting in direct shares.
Yeah.
And I want to buy in 3 months' time. I don't want to take the money out now because I want to make some more return before
Get me the
I get
approval
out.
and then I'll take the money out.
Yeah. And
Okay.
how big of a... And we saw this once again coming back to March last year with KiwiSavers being in growth funds when they were used for their first home deposit. The market corrects. You can't settle on the home. You can't achieve your goals. Thinking about your time frame to invest, not just your risk tolerance. What are you trying to work towards?
Yeah, exactly.
Look, the other driver is, and it's a fair one for my children's generation, who are 25 and 28, looking to get into the property market almost as non-existent. So I think stuff, I'm not going to be able to buy into a house, so where can I or should I be putting my money if they are thinking about saving? And that's where these platforms tend to get and have had a lot of support through those, particularly that generation, I suspect.
Yep. Okay, so we've gone through some of the pros of these platforms, the accessibility, education, diversification, these sorts of things. Some of the cons, people are losing money. They're not doing the research. If there is a market correction, they are going to feel that. And also around the research and the fundamentals that people are putting into their investments, or are you just looking for a Hail Mary play? Advisors, the other side of the coin. They don't want to speak to me. They're stuffy. They're boring. They've given me 15 pages that I got to sign and initial and put my blood thumbprint on. Why should I go speak to an advisor? They don't want to speak to me.
Well, the blood thumbprint is so we own your firstborn child.
It's pretty obvious. Look, that's a really good question. And if we take a step back, we came from a pretty unregulated environment around advice, and this is talking around insurance, mortgages, and investment. So the regulator has done a very good job around tightening the profession, and it did need to be tightened, and there's probably still a bit more work to be done. And it wasn't just the advisors. We had large financial organisations known as banks that pretty felt the wrath of the regulator, particularly in Australia and in New Zealand, around behaviour, and that's a big thing. The problem that you have though is that if you continue to regulate, that comes more costly for the advisors, and I know this because I talk to a lot of advisors, is that many of them just can't afford to talk to those who've got smaller amounts of money because of the way that they get remunerated, which is in most cases now working towards a fee rather than which is great, but to ask someone quite younger to part with some hard cash to get some advice, you really got to work out, well, what's the value for them and would they do it? And at the moment, we've got less advisors, and I suspect after regulation kicks in, the full licensing that comes in 2023, there'll be less advisors than there are today.
Yeah, I know for us hiring new advisors, bloody hard to find them.
Yeah, yes, it is. And the one thing that I've noticed, which is fantastic, is those that were and have been coming through the mortgage and insurance environment, they're starting to spread their wings a little bit and seeing the value that they can bring, probably initially through KiwiSaver in an investment area, and then building that up. So, kind of the glass half full from my perspective is that if we can get more, New Zealanders into that environment, then over time we'll have a bigger group and greater access to advice at different levels. At the moment, probably those who've got $1 million or whatever to invest, you'd suggest that they probably don't need a lot of advice because they've got a pot of gold of some sort. It's about the accumulators, and that's what we need to focus on.
Yeah, and I was saying to my analyst Mitch yesterday as well, is that dealing with the people who have $20,000 are much more difficult than the people who have $10 million, because you're probably not getting all of the person's money who has $10 million, while the $20,000, they've scrimped, they've saved, it's everything they've got.
Yeah.
And then that requires, you argue that person needs the most advice. This is a tricky thing with advice, is the people who can't afford it are probably the people who need it the most, but require more time. How does the model look for the advisor? Yeah,
so you bang on. That analogy is a good one because, for many of us, we've had to work on our, from the sweat of our brow to save this kind of money up. If you're in property, well, you've got some capital, but you still need to unlock that at some stage to access it. So I think really what's happening in this industry at the moment is you've got those that they've built up some wealth, they've had it sitting in the bank, they're not getting any return on that. They're looking to get some advice or information even to move into something a little bit more risk, but with better reward. This is where they need the advice. Those people particularly, not necessarily making that decision, but holding them to that decision when the markets go down, so they don't realise that loss.
Yeah.
And I think that's where advice comes in, and we've got to find. And this is my kind of beef with the industry and the regulator as well, is how in New Zealand can we provide affordable advice for those New Zealanders that need it, and don't tell me it's a robo kind of advice thing, because that is part of it, but I think there needs to be more support with it. And just one other thing, because you got me on a tangent now. Get really,
that's good.
I won't be on the FMA's Christmas card list, I suspect, but. We've got to look at other countries, and ASIC, after all their regulatory change, have finally found out that the affordability of Australians to get advice is not there. So they've written this paper, they're getting it out to the market and trying to work out how do they do it now. Well, it's kind of like the horse is bolted. So what can we learn in New Zealand before we get to that stage to help New Zealanders that really need it, but they also need to pay for it at some level and not be shy of that. Sorry, that's my rant.
I 100% agree. The robo thing triggered me because I remember how much money the bank I used to work for paid for robo advice, which essentially got nowhere and in the end and was the hot thing for a couple of years. But the paying for advice in New Zealand, I think, is very relevant. We've got lots of clients at Lighthouse who get it, and they go, hey, if I'm paying X amount, but my return on this is Y, and I've got peace of mind, and I've got security for my future, it's money well spent. But I think generally speaking in New Zealand, and the tricky thing about the model going forward is Kiwis understanding the value and being willing to pay for advice.
It's very hard to show someone the future, or probable outcome of that future. So the challenge that advisors have in our industry as a whole is actually getting that credibility. And I think that's building really well relative to where we were maybe 20 years ago. And genuinely, we've got better tools, support, and government, through the Commission, but also FMA. I mean, they're doing their bit to kind of drive awareness, but the awareness needs to be through the channels where our younger generations are playing, and we need to connect with them in a way that they'll understand it, rather than perhaps what we've always tried to do in the past. And that's why getting it into schools is just has been a really good step, and there's a lot of work to be done in that area. But if that generation and future ones from that point are in a better position, well, then you're kind of the ambulance at the top of the cliff, and not dealing with where we saw just recently, if you want to enjoy a happy retirement at 65, going by the Massey University study, you need $809,000 plus your super to have what they call a choices option. I mean, wow.
James, you and I had a quick discussion about that, and I was like, I don't know what the choice is there between PAMS or home brand. I don't know.
It is, and I think though even the choices is pretty limited. So. But if you tell someone that they need $1 million before they can retire, even now, probably doesn't sound as bad probably 10 years ago as it is now. But how are they going to do that?
Yeah.
So this is where advice and support and good quality information can help people get started earlier. Yeah. And the earlier start, the easier it is.
Yeah,
basic stuff.
If I can, let me try and distill what I can from that. So really, the cons obviously are to the average investor is probably some of the fees, especially those with smaller amounts of money, especially if you compare that to say some of the platforms. But the benefits there is inherently the advice, right? And it is having someone who knows what they're doing, give you the guidance around where to put your money, but also that reassurance of when there are market corrections, there are ups and downs. It's if the market drops off, it's not, hey, we're shifting everything out of this into this and making all these changes that are going to crystallize these losses. Anything else you guys want to pull from that?
Oh, look, the only thing that I'd get if there are younger people listening to this is, and I'm into music in a big way, so I deeply missing concerts at the moment, and seeing live acts. It's killing me. If I was going to, and they probably wouldn't be going to a concert like this, but if they were going to like Queen, and I probably spent $400 on a ticket. That's an investment that is, a memory. It's great. It depends on advisors what they charge, but if they spent $400 or $500 for an hour's time of an advisor that sets a plan or strategy, might be 2 hours, that impact would be massive. And I think that's what we need to bring to life in our industry and show the value of that and how that decision making and support and hand holding and setting goals and objectives really comes to life. And it's a beautiful thing.
It's a really good way of putting it. And I have thought about that in the past, where people will spend thousands of dollars on Christmas presents or birthday presents or whatever and go, $1,000 for a financial plan, what a waste of money.
So we got to unwrap it. And maybe that's the analogy. And maybe, give yourself a Christmas present this year while you've got the time. COVID's a great time and has been a time to reflect on many things. Some people have changed careers because some have had to, but they've also found opportunities. So, invest in yourself. I mean, it's a good start. Just get someone who's, certainly qualified, that knows what they're doing, and you can relate to them. That will be the best investment you could ever make.
Cool. Yeah. Okay. So I think one of the big ones here as we wrap up is that if you want to be heavily involved in your investment decisions, or for those starting out quite small and you want to educate yourself, those platforms can be really good resources. There is also the option of having a platform with an advisor. That can also work where you're having more of a strategic discussion opposed to investing. But for those who want to invest in their future, have peace of mind, want somebody to bounce ideas off, the fact we don't talk about money in New Zealand, having a financial advisor can be that personal CFO to help you achieve your goals long term. So, David, thank you very much for joining us.
Thanks, James.
It's been great to have you.
Cool.
Please make sure before we go, give us a subscribe on YouTube. Please give us a review on Apple, and we'll see you next week.
Cheers.